Hello friends, let me carry forward from where I left in my last video. This is part 2. If you have not seen my part 1 of various intermediaries or facilitators in capital market, kindly watch my YouTube channel. You'll get one more video section where approximately 12 to 13 intermediaries have been shared. Now we are carrying it forward to see some of the additional intermediaries which are there, facilitating various trades and investment uh, on capital market. Let's start with it. You see, you will come across some more terms when you go into capital market. Like two types of entities which are available to us is like venture capitalist firm and private equity firms. From their name itself, it is very much clear. You see, you need to understand these are firms with some sort of speciality. Now, you see, venture capital firm means what? You are actually a person. Let's say you are a person with some creative idea with very good feasibility of commercialization, but you don't have money. Okay, you go to a bank and you try to borrow. So bank is asking you for collateral, hence you are not able to take a loan. You don't have your self finance too, because the commercialization level of commercialization that you require will require decent amount of money, and you have to depend on someone. Now you see in this case, venture capitalist firm will come in. What are they doing is like they are going to act as a facilitator. They'll give you the early stage funding and they'll take equity participation. And what is happening is like they'll have resources, you have your idea. You'll come up together, will team up. Your idea will be actually put into commercialization by their resources. So when it comes to profit sharing, once this project is implemented, it is sure that we are going to get some profits too. So profit sharing ratio must have been predefined. Venture capital firms, you see when someone is giving money to you for your experimentation, you see here there is an underlying uh, phenomena that is like they charge a lot. They're very commercial in nature, so they will be very, they know it. Why? Because if something goes wrong, they are at risk. Hence the share of profit which they are going to expect from person with idea is going to be a little bit on a higher side. Hence they are called as exploitative nature. But what choice do you have? They not only give money, but also they'll arrange expertise or something else that you need from industry. You see, if you have money, you can get anything and everything. Hence, with their money, they can give you all sorts of advisory services that you need to start your product. And you see, for this, they actually take a decent amount of profit in their kitty. Next is private equity firms. So private equity firms is again similar sort of thing. Like we had a discussion on venture capital. What they do is like they give money. Private means limited number of owners. Okay, private equity firm means you have few people who have resources but they don't have time for active participation in company. What they do is like they'll give you money, and this money is collected by few big investors, not by many. Like in case of an IPO, you go to everyone, but here you don't go to everyone. It is actually a company which has its own investor base, and they people actually pull in resources, and this money will be used to start, or like let's say to run a company smoothly. Okay, so again they have two types of two categories of investor. One is active investors who take active part in decision making, and second is passive investors who don't put in any effort except giving their resources, giving their money for investment purpose. Okay, so what they do is like they usually acquire a company by putting in their investments, any by taking equity participation, and then they help your company to go very fast. Okay, when you start a small dhaba, it is not recognized. But let's say your idea is good, your location is very strategic, you are getting good clients, and then you see some person who is having heavy amount of investment available in their pocket, they comes in and start investing in your particular dhaba. You see, you need to have promotion, you need to have branding, you need to have, like you see, endorsements everywhere to be done. Once you do it, you see your name will flash like anything. You may start a chain of dhabas all across India. For that, you need advisory. For that, you need strong investments. For that, you need some advisor, very high costs, high professional fee advisors. So this team can be brought in by heavy investments. Let's go forward. The next set of couple of entities who are going to come in our discussion of stock market intermediaries is like you have commodity exchange. Like you have stock exchange, similarly in similar lines, we do have commodity exchange too, where you see commodities are being traded. It can be agricultural product, energy resource, or any metal. Okay, so producers and consumers, they can come face to face, or they can come virtually, and you see they can manage their price risk. Any future adversities can be very well managed here. Next is real estate investment trust. Now you see, again, this is a new type of investment option where investor need not to own a real estate property. Okay, yani usually when you invest in real estate, what you have to do is like you have to own a property, you have to go for registry documentation, and then you may be able to get some income out of it. But here, now they have come up with something called as real estate investment trust. Here they are actually, when you put your money, you see, you may not have 10 lakh, 20 lakh to make a house, but let's say you have only a couple of lakhs, 2 lakh rupee available in your pocket for investment purpose, and you see real estate sector is giving you the best return. What you can do is like you can invest in real estate investment trust, the 2 lakh rupee. So they'll pull in the resource, they'll make real estate, or they'll buy some real estates, will try to generate income out of it, and then that income which they are able to generate from this real estate investments will be split into the investors base in an equal proportion, in line to the contributions. So rental income is what they're going to get as a source of income, and this income will be split into all investors. Let's go forward. Now the other two categories that are going to be there is like they are specifically connected to data. So market data providers, you see, in market, timing is very important. When I say timing means when to enter and when to exit. And you see, how will you take your decision to enter into capital market or to take an exit from capital market? It is only possible when you have reliable and data given to you very fast. If something is happening in, let's say, in any company, and that company information is coming to me through newspaper, and through newspaper, if I'm reading it and then making my decision, it may be very late. So instant availability of data is what is very important. Transparency is very important. Information should travel very fast. Now here, market data providers, they provide you information on stock price, trading volumes, various financial news at real time speed. Means it will be very fast. You get this information and you use it for decision making. Okay. Now next is financial news media. Means again, you see, you're connected to media, news media through digital and traditional modes. Traditional mode cannot help you much, but now you need to have a digital connect. Something happening in some part of India, if it reaches to you, it helps you in taking a rational call, maybe to buy or to sell. You see, but if information is reaching you late, what it means, information has already been discounted by others, so you'll not be able to take a rational call, but other people might have taken their rational call. So you see, let's say a huge profit happening in a company, if this news comes to you late, means by the time you go back to the stock and you show your inclination to buy it, the share price might have already shot up like anything. So timing is very important, and for that you need data and information. These entities helps you with it. Now next two category which are coming in is like you have a very important facilitator which was not there in first round. It should be in first round of discussion. Underwriters. What are underwriters? Underwriters are people who help you in risk mitigation. Let's say you see you are coming up with an IPO. In IPO, minimum subscription required is 90%. 90% means if you bring in 100 shares, so minimum 90 shares should be applied by common public at large. If they don't apply or they show interest to buy it, that means it is a failed IPO. So in order to avoid this failure, companies usually hire the services of underwriters. Underwriters take some commission, and they make sure that your issue is always going to be a success one. Okay, so they'll make sure, they'll arrange it parties for buying your stock. Okay, and similarly you do have advisory firms who are proxy in nature. Proxy means, you remember in college days, school days, when sometimes in class teacher is taking a roll call, and some students who are not there in class, their friends are trying to mark proxy. Proxy is something in absence. Okay, so proxy voting, or helping you on various issues on corporate governance and compensation structuring. You see, they may not be active part of your team who is supposed to do this job, so they helps you in it by giving you their inputs. Okay, so let's say this is an outsourced contract to this agency, Whatever task comes to you, you don't have time, you outsource it to this agency. They help you to frame it very fast because of their expertise. And you see, you can simply take their services paying a commission. Now next couple of categories are like financial advisors and credit intermediaries. You see, advisor is very important. Without advisor, you cannot buy anything in market. Being a new person to market, so it is always recommended because they tells you what are do's and don'ts in this market. Okay, so advisors are people who give you guidance how you enter, how you can enter into this market. Timing is, you see, advisor means like a coach. He helps you when to go in, when to come out, when to be very defensive in your investments, when you need to be very aggressive, means buying stocks. So, looking into your risk appetite, your financial advisor will guide you your portfolio according to your risk taking capacity. Okay, so is very important. Next is credit intermediaries. These are banks. Sometimes they are also called as credit unions who are helping you for taking loan or credit facility in individual capacity or in business capacity. Okay, so you see, they are very important. And I'm not getting money from a bank, hence I'm going to capital market. So, but when you look into your journey, credit institutions are very, very important. Any company will have to start with their own funds. Later on, they have to go to banks. Once banks' capacity is exhausted, then you have to go to capital market. Okay, so it is actually a long journey. Now, next couple of important players who are there nowadays. Technology is booming like anything. Everywhere you go in, and you will find technology. So you have fintech platforms who are actually operating your market, who are actually running your market. You see, I tell you, I'll give you one example. Algo trading. Manually, let's say you have been given a laptop and you can enter into a contract. Maybe you can do 10 clicks in 1 minute, or let's say 20, 30 clicks in 1 minute. Means you can enter 20, 30 contracts. But what if you have to enter 1000 contract at same point of time? Manually, it is not possible. So we have to bring in technology. So that fintech is revolutionizing your market. Okay, they are bringing in lots of options for your investors. And not only this, even regulators require technology. Regulatory bodies, they need technology to monitor your market. Yes, technology is changing things very fast. The speed at which transactions are being executed is is very, very short. Hence, being a regulator, they need to ensure that market rules are there, their market game is played with some ethics. So regulatory framework is also needs to have technological impetus into it, and hence regtech is again a word which is catching up. And finally, we do have something called as an exchange where derivative transactions are done. So derivative is like again certain promises to buy or sell something in future. Derivatives are of multiple types. I'll name some of them: futures and options, and then you have swaps, and one more thing is there: future option swap, forward contracts. So forward is not actually done on stock exchange, hence it is not mentioned here. These instruments are used for hedging, speculation, and risk management. Okay, with this, I feel like the topic of various types of intermediaries in capital market is well covered. So let's hope for the best. If you have any questions, you can put in chat. Along with this, last couple of entities which I missed out is you have security lending agents. Like you see issuing and paying agents. Now I'll summarize both of them together. You see, you have some stocks in your custody. You have bought it. You have invested in these stocks. Now you want money. Okay, you want money and you don't have money in your pocket. What can you do? Is like you can actually start raising some money. Raising means you can borrow it from these entities who are actually lending to various people on the security of existing stocks. Okay, or you can keep a margin and can raise money. Let's say, you see, in various broking firms, the rules regulations may differ. So if you need money for investment, so you see it is required like you have to bring in 25% of margin from your side, and remaining 75% will be given to you by this company. Why they are interested in giving you 75% is like because you're using their platform for buying and selling. So if something goes wrong, they are in charge. They have a control on your securities in which you are investing. So they don't have any risk. They don't have any major risk connected to them. And you see what is happening is like when you as a company are allowing your investors to invest three times or four times more than what they have in pocket, the volume of trade is going up, and it leads to income generation. Okay, this is the benefit of that lender. But on the other side, you see, as an investor, you are also able to make profit three to four times more than what you usually can do. And when you are getting this option of borrowing and then investing this money in share market multi-fold, so you see your profits will also go up. It is always a two-way process. Higher the risk, higher will be the return. Not only risk and return, but also you see losses are also there, so be careful. Issuing and paying agents, they helps you in various administrative tasks, like issuance of security, distribution of interest payment, managing bond redemption. Like you see, this is a specialized body whose role is to support you in distribution of dividend or interest payments. Dividend warrants need to be printed. I remember when I was working in a bank, I used to go to HDFC Bank. There, they used to print some dividend warrants because they were acting as an agent for someone. So you see, lakhs and lakhs of dividend warrants will be printed for shareholders. Maybe the amount is sometimes very less, 10 rupee, 20 rupee per share. So you see, if you have 100 shares, so 10 rupee means 1000 rupee. So dividend warrant for 1000 rupee will be issued. So likewise, you have to give it for very huge number. So this type of task is also getting outsourced. Hope this topic is clear. Uh, Good day. Take care. Bye.